The rules of capital are changing, quietly, decisively, and without apology. While most investors are still arguing about inflation prints and interest rate headlines, the real shift is already underway behind closed doors. This isn't about trimming at the edges or chasing the next hot trade. This is about moving half the portfolio on purpose into the forces that will define who wins and who disappears in the next decade. What I'm about to share isn't driven by hope, hype, or headlines. It's driven by data, inevitability, and conviction. Because when the world rewires itself, capital either moves first or pays the price for being late. We are living through a moment where capital either adapts to structural change or it gets quietly left behind. Markets reward clarity, not comfort. And when we looked hard at the global economy, stripped away the noise, the headlines, the political theater, one reality stood out with absolute precision. The next decade of returns will not be driven by cyclical rebounds or short-term stimulus, but by foundational technologies that permanently change how value is created. That is why a decisive reallocation of capital is not just reasonable. It is necessary. Artificial intelligence, advanced computing, and digitally connected ecosystems are not speculative ideas. They are already embedded in how companies operate, compete, and scale. AI is no longer a research project sitting in a lab. It is deployed across logistics, finance, health, defense, manufacturing, and consumer platforms. It improves margins, reduces friction, and compounds efficiency. When a technology does all three simultaneously, it becomes infrastructure. And infrastructure is where long-term capital belongs. The same is true for cloud and compute platforms. Every meaningful innovation today runs on scalable, elastic systems that can process data in real time. Businesses are not moving back on premise. They are accelerating their dependence on platforms that offer speed, security, and global reach. This is not a trend. It is a one-way migration. Capital follows inevitability. Companies that own these platforms are not just selling services, they are embedding themselves into the operating systems of the global economy. Then there are digital CTED ecosystems, platforms where attention, data, and monetization converge. These networks benefit from scale in a way traditional businesses never could. Each additional user strengthens the system, improves targeting, enhances data intelligence, and lowers marginal cost. That creates durable competitive moats. When you see recurring engagement, diversified revenue streams, and pricing power tied to network effects, you are looking at assets that can compound value for years, not quarters. Reallocating capital toward these sectors is not about abandoning discipline. In fact, it requires more discipline than ever. It means exiting positions where growth is fully priced in, where narratives have outrun fundamentals, and where competitive advantages are eroding. It means reallocating toward businesses with real earnings power, balance sheet strength, and leadership positions in markets that are expanding regardless of economic cycles. This is how institutional capital thinks. It does not chase momentum. It anticipates structure. It recognizes that the world is becoming more data-driven, more automated, and more interconnected, and that companies enabling this shift will capture proportionate economic value when half of your capital is aligned with the engines of long-term productivity growth. You are not making a bet. You are positioning for reality. History is clear on this point. The biggest returns are generated not by reacting late, but by committing early with conviction. Capital that understands where the world is going doesn't wait for consensus. It moves decisively, calmly, and with purpose, because the future doesn't announce itself. It compounds quietly for those who are prepared. When you study markets long enough, you learn a simple truth. Growth that depends on favorable conditions is fragile, but growth that is built into the architecture of the economy is resilient. That distinction matters more today than at any point in recent history. Volatility. Thank you, geopolitics, inflation cycles. These forces come and go. What endures are platforms and technologies that businesses cannot operate without. That is where serious capital migrates. Artificial intelligence sits at the center of this transformation, not because it sounds impressive, but because it solves real problems at scale. It compresses time, enhances decision-making, and turns raw data into actionable intelligence. Companies that integrate AI deeply into their operations are not just becoming more efficient, they are redefining what efficiency means. That creates a widening gap between leaders and laggards, and capital naturally concentrates where competitive advantages expand rather than shrink. But AI does not exist in isolation. It requires immense computational power, aided software layers, and global infrastructure capable of supporting continuous learning and deployment. This is why advanced compute and cloud ecosystems matter. They are the backbone that allows innovation to move from concept to execution in weeks instead of years. Businesses that control this backbone gain pricing power, customer lock-in, and recurring revenue streams that are remarkably durable. In a market obsessed with quarterly narratives, durability is often underappreciated, and that creates opportunity. Connected digital platforms further reinforce this advantage. These ecosystems sit at the intersection of technology and human behavior. They capture attention, generate data, and monetize engagement across multiple channels. What makes them exceptional is not just their reach, their adaptability. As consumer habits shift, these platforms evolve faster than traditional enterprises ever could. That adaptability is a form of risk management, one that is built into the business model itself. Allocating capital toward these areas is not about optimism, it is about realism. The global economy is becoming more digitized, more automated, and more dependent on intelligence embedded in software. Labor costs rise, supply chains grow more complex, and regulation tightens. In that environment, companies that reduce friction and improve productivity are not optional. They are essential. Essential businesses command premium valuations over time, even if markets temporarily disagree. This approach also demands humility. No allocation is permanent. Capital must be constantly tested against new information. Positions are increased when evidence strengthens and reduced when assumptions weaken. That process is not emotional. It is methodical. It recognizes that protecting capital is as important as growing it. Ultimately, the goal is not to predict the next headline, but to own the infrastructure that makes future headlines possible. When capital is aligned with systems that power global commerce, communication, and computation, it benefits from forces larger than any single market cycle. That is how enduring portfolios are built, quietly, deliberately, and with a clear understanding of where the world is actually headed, not where it was. Markets often reward confidence, but they punish complacency. The most dangerous assumption an investor can make is that yesterday's framework will explain tomorrow's outcomes. Economic leadership is changing, not gradually, but structurally. Capital that fails to recognize this shift doesn't just underperform, it becomes irrelevant. That is why reallocating capital toward transformative sectors is not a tactical adjustment, it is a strategic imperative. One of the defining characteristics of the modern economy is the velocity of information. Decisions are made faster, competition is global by default, and advantages compound quickly for those who lead. Technologies that accelerate insight and execution therefore sit at the center of value creation. Artificial intelligence is the clearest example. It allows firms to move from reactive decision-making to predictive systems. That shift fundamentally changes margin, scalability, and resilience. When intelligence is embedded directly into operations, growth is no longer linear. It compounds, but intelligence without infrastructure is theoretical. Advanced computing platforms and cloud architectures turn algorithms into economic output. They provide the scale, security, and flexibility required to operate in real time across geographies and industries. These e-platforms are not easily replicated. They demand massive capital investment, engineering excellence, and years of iteration. That difficulty is precisely what creates enduring competitive moats. Capital gravitates toward businesses where barriers to entry rise, not fall. There is also a behavioral dimension that markets often underestimate. Digitally connected ecosystems don't just serve customer They shape habits. When a platform becomes the default environment for communication, commerce, or content, switching costs increase and loyalty deepens. Data generated by these interactions feeds back into optimization, improving targeting, pricing, and engagement. This feedback loop is one of the most powerful forces in modern capitalism. It allows leading platforms to grow more efficient as they grow larger, a dynamic rarely seen in traditional industries. Rebalancing toward these sectors does not imply a disregard for risk. On the contrary, it reflects an understanding of where risk truly resides. The greatest risk today is not volatility. It is obsolescence. Businesses built on outdated models may appear stable, but stability without relevance is temporary. Capital preservation requires anticipation, not reaction. It requires recognizing which industries will command resources, talent, and pricing power 5 and 10 years from now. This approach also acknowledges that markets misprice transitions. Early in structural shifts, skepticism dominates. Valuations fluctuate, narratives conflict, and consensus lags reality. That is precisely when disciplined capital establishes positions, not by chasing excitement, but by underwriting long-term cash flows, competitive positioning, and strategic relevance. In the end, reallocating capital toward transformative sectors is about alignment. Alignment with how businesses operate, how consumers behave, and how economies scale in a digital world. When capital aligns with these forces, it benefits from momentum that does not rely on optimism or speculation. It relies on execution, infrastructure, and inevitability. That is how enduring advantage is built, not through prediction, but through preparation. Capital markets are not sentimental. They do not reward legacy, reputation, or past success. They reward relevance, and relevance in today's economy is defined by adaptability at scale. The institutions and companies that thrive are not those that resist change, but those that absorb it, systematize it, and turn it into durable advantage. This reality forces a continuous reassessment of where capital truly belongs. The global economy is entering a phase where productivity gains are no longer optional. Demographics are tightening labor markets, supply chains are under constant pressure, and geopolitical uncertainty. NTI has raised the cost of inefficiency. In that environment, businesses that can do more with less gain an asymmetric advantage. Technologies that automate judgment, optimize logistics, and enhance precision are not just improving performance. They are redefining the cost structure of entire industries. Capital naturally flows toward those enablers. Advanced data systems and intelligent software are now embedded in every serious enterprise strategy. They reduce error, compress decision cycles, and unlock insights that were previously inaccessible. This is not about replacing people. It is about augmenting capability. Firms that adopt these systems early build institutional knowledge faster, execute with greater consistency, and scale without proportional increases in cost. That combinatio, scalability without friction, is rare, and it is immensely valuable. Infrastructure matters just as much as innovation. The platforms that host data, computation, and connectivity are becoming the rails of the modern economy. Once businesses migrate onto these systems, the relationship becomes long-term. Contracts renew, usage expands, and integrations deepen. This creates predictable cash flows. Switching costs. In uncertain markets, predictability is a competitive weapon. Capital prioritizes it because it lowers risk without sacrificing growth. Equally important are the ecosystems that sit on top of this infrastructure. Digitally connected platforms bring together users, advertisers, developers, and enterprises into self-reinforcing networks. Each participant adds value to the system, strengthening the whole. These ecosystems are flexible by design. They can pivot monetization models, expand into adjacent markets, and absorb regulatory changes more effectively than siloed businesses. Flexibility at scale is resilience. Reallocating capital toward these areas requires clarity of judgment. It means recognizing when capital is better deployed forward rather than anchor to familiar models. It means accepting short-term volatility in exchange for long-term dominance. This is not speculative behavior, it is strategic positioning. The goal is not to time the market, but to own assets that grow in importance as complexity increases. Every major economic shift produces winners who understand the direction of change and act before consensus forms. The transition to a more automated, data-driven, and interconnected economy is no different. Capital that aligns with this transition benefits from forces that compound quietly over time. It is not driven by headlines or sentiment, but by fundamentals that strengthen with scale. In the end, disciplined capital allocation is about one thing: ensuring that resources are deployed where they can earn relevance tomorrow. Not just returns today. That is how long-term value is created, by investing in systems that define the future rather than defend the past. The ultimate responsibility of capital is not to chase opportunity, but to recognize inevitability. Markets fluctuate, narratives shift, and sentiment oscillates between fear and euphoria, but beneath all of that, structural forces continue to move forward. With remarkable consistency, the role of disciplined capital is to identify those forces early and align with them before they become universally accepted. We are entering an era where scale, intelligence, and connectivity determine competitive advantage. Businesses that master these dimensions do not merely outperform, they reshape the landscape around them. Technology is no longer a sector, it is the operating environment for every sector, whether in finance, healthcare, manufacturing, or logistics. The same reality applies. Firms that integrate intelligent systems into their core processes gain speed, precision, and resilience that others cannot easily replicate. This is why reallocating significant capital toward transformative sectors is a matter of strategic survival, not ambition. Intelligent systems lower costs while improving outcomes. Advanced platforms allow companies to expand globally without building physical infrastructure at the same pace. Connected ecosystems capture demand, analyze behavior, and monetize engagement in ways that traditional models cannot match. These advantages do not disappear during economic slowdowns. They intensify, a defining feature of successful capital allocation is the willingness to be misunderstood in the short term. Structural shifts are rarely comfortable. They challenge existing assumptions and disrupt familiar benchmarks. When capital moves ahead of consensus, volatility follows. But volatility is not the enemy of long-term returns. Misalignment is. The real risk lies in allocating resources to businesses whose relevance decline. As complexity increases. Risk management in this context is not about avoiding uncertainty. It is about choosing the right uncertainty. Investing in static models carries the risk of erosion. Investing in adaptive systems carries the risk of transition. History shows that transition risk, when backed by strong fundamentals, is far more manageable than erosion risk disguised as stability. This approach also requires constant evaluation. Capital is not loyal to ideas, it is loyal to evidence. Positions are scaled when performance validates assumptions and reduced when signals weaken. This discipline ensures that conviction remains grounded in reality rather than narrative. Flexibility, guided by data, is a competitive advantage in itself. As economies become more digital, more automated, and more interconnected, the gap between leaders and followers will widen. Companies that enable productivity, intelligence, and scale will capture disproportionate value. Capital aligned with those enablers benefits from growth that is structural, not cyclical. The objective, ultimately, is not to predict the next market move, but to build a portfolio that thrives regardless of short-term conditions. When capital is positioned in assets that grow more valuable as the world becomes more complex, it does not need constant adjustment. It compounds quietly, consistently, and with purpose. That is how enduring investment outcomes are achieved, not through reaction, but through alignment with the forces shaping the future. So understand this clearly. This is not a shift made in fear, and it's not a bet made on optimism. It's a decision grounded in inevitability. Capital doesn't wait for permission, and it doesn't move after consensus forms. It moves when the future becomes obvious to those willing to look early. The next decade will not reward hesitation. It will reward alignment. And when the dust settles, the DIF. Difference between those who watched the transformation and those who owned it will be unmistakable. This is where the capital is going, because this is where the future is being built.